Hey guys, it's Dwayne Becker here. I'm a mortgage agent and investor, and today we're going to be talking to Bruce Smith. He's a consultant with Cash Management Group. He's based in London for the last 20 years with a focus on private financing and is an accredited lender. He holds a Bachelor of Business Management degree and is also a real estate investor. He's contributed to publications such as London Incorporated Magazine, Enterprise Magazine, Canadian Mortgage Professional, and The Londoner. We welcome Bruce to our discussion.
Thank you, Dwayne. Glad to be here.
So today, I'd actually like to talk about the property ladder and getting onto it. So first-time home buyers may have, shall we say, more questions and or some more challenges perhaps to getting onto the property ladder. One of those challenges would be the stress test. So how does this affect people buying properties, that stress test?
Okay, so the basics of buying a property, you need three things. You need to have income, you need to have credit, and you need to have a down payment. So a mortgage is just some combination of those three things together. So when you're looking at something like the stress test, that just affects the income component. So a lender is going to look at this and say, it doesn't matter what rate we're charging you on the mortgage, you have to qualify at the stress test of the day. And so the thought being that if interest rates go up, then you won't be in trouble. You'll still have the capacity to make your mortgage payments on renewal. So we're in a situation right now where, we're probably looking at higher interest rates. So the government's recognized that. So they have increased the stress test just to make sure that people can still afford their houses once they come off, when it comes up for renewal again. It's as simple as that.
So as much as we'd like these videos to be evergreen, lately people have been talking about the changes in the stress test.
Right.
Now, the stress test changes that they've made back in June just brings it back to what it actually was a year ago today, right? So last year, the stress test was at 5.25%. It lowered because of our interest rates going down, and now it's just back to where it was a year ago today. So really, as much as people like to make news headlines and stuff, right, to stretch things out, it drops your payment, or it drops your qualifications down by about 4%.
Yeah, it could have an impact on some people with rising house prices, especially here in London. It's been such a vibrant market for the last 4 or 5 years. It's getting very difficult for people, first-time home buyers, to qualify for a home. I feel sorry for younger people, because essentially you need to have two-income families, good paying jobs to qualify now to buy a detached home in London. I think the average price, when I was doing this several years ago, like the average selling price was 250,000 or something in London. Now it's like 600,000 or over 600,000 last reports. So it's really crazy. But it goes back to the income. So the lenders are going to look at ratios, your income versus your mortgage payments, and then your income versus all your other debt. So it's called gross debt servicing and total debt servicing. So essentially, with average credit, 35% of your income, that'll qualify from the mortgage standpoint, and then they'll go to 42% for total debt. So it's at 35, 42. If you have really good credit, above 680, now it goes up to 39 and 44. So you are rewarded by having good credit. The stress test has just made it more difficult. People qualify for a smaller mortgage, less house. So people, have to make some decisions on what they're going to do. Or, you're finding a lot more, parents going on deals for their children, parents gifting bigger down payments for people, because you can buy a house with 5% down, essentially 5% down with an insured mortgage, and the insurance is the lender's insurance that if you default, that they go back and collect from the insurance company. So with a principal residence, you only need 5% down to buy a house. If you're buying a rental property, you need 20% down, or you want to avoid those fees, those insurer fees, you need 20% down. So we're seeing parents stepping up and saying, I'm going to give you X amount of dollars to to help you qualify, because you just can't buy a house based on your income.
So actually, funny enough, so people will come to me and they'll ask about somebody co-signing on a mortgage, which is different from being a participant on a mortgage.
Right.
So what is the difference between a co-signer and a co-participant mortgage?
Okay, so as a co-signer, they have to have the ability to pay the mortgage on their own. So a lot of times, people come in, they say, well, my parents are going to be co-signer, my mom or dad are going to be co-signer. Okay, so you understand they have to have the capacity to pay your mortgage 100% in addition to servicing all their existing debts. So they may have a mortgage on their house, they have other liabilities. So it takes a lot more to be as a co-signer, because you have to have 100% capacity to pay the mortgage. As a co-participant, collectively, they need to qualify. So perhaps they don't have enough income, mom can get added on, mom becomes part owner of the house, and it's easier to qualify because now they're qualifying collectively. So people would say, well, I don't want mom on the house and owning half my house. Well, mom doesn't have to own half the house. Mom could own 1% of the house. You could own 99% of the house. That's something you can work out with a lawyer. But you need mom's income to put this deal together. Mom's doesn't have enough income to qualify on her own. She can't make your mortgage payment plus her mortgage payment plus all her other existing debts. So that's essentially the difference between the two. So it is easier if they're co-participants on a deal. So we'll see that. And then, once you qualify on your own, then take mom off the deal in 5 years when it comes up for renewal.
So as a first-time home buyer, you probably haven't gone through the process of buying real estate. What do we need to prove a down payment? So you need a down payment for a home, right? You need something in.
Right.
What do we need to prove that?
Okay, you need 3 months of bank statements to prove that you have the money in your account. And lenders are also looking at any large deposits that might have gone into your account recently. So it's kind of ironic that if the money's there for 3 months, it's your money. If it's before that, they don't care. But they're concerned about any large deposits, because there's always concerns about proceeds of crime, laundered money, etc. So when you see someone has no money, then all of a sudden 50,000 shows up in their bank account, then that's the red flag for lenders. Okay, Bruce, where did this 50,000 come from? So then we have to prove it. So yes, it came from the sale of a vehicle. Here's the bill of sale for the vehicle. It came gift from a parent. So here's the gift from the parent. Whatever the source is, we can use it as long as we can justify it. But also, it has to be, when we talk about gifts, it has to be a legitimate gift. So your buddy at work giving you $50,000, they're not doing that out of the goodness of your heart. Lender knows you're going to have to pay that back. So they're going to say, okay, this isn't a gift, this is a loan. So let's factor in some loan payments on this loan. If you can still qualify, then you can borrow your down payment for a principal residence. But then, you have to factor that loan into your qualifying ratios. So you can. So if you can borrow 50,000 and still justify it, or you go to the bank and get a line of credit, and as long as that debt can be supported, then you're still okay borrowing the money. Now your insurance fee, there will be a premium attached to that, because obviously they prefer you have your own money. But in theory, you can borrow your down payment on a principal residence. So.
Provided it all fits into your debt servicing.
Exactly.
Right.
Exactly.
So we've covered down payment. We've credit. So what does it take to have good credit?
Okay, so typically we're looking at a score, and a 680 score and above is good. So scores range from 300 to 900. So anything usually over 680 is considered a good score, and that qualifies you for the maximum amount. But there's more to it than just the score. And I always give the example, let's say a university student will come up to me and they'll say, Bruce, I just pulled my credit. I have a 700 credit score. I have great credit. And I'll look at the credit report and say, you've got bad credit. What do you mean? My score is 700. That's a good score. I say, yeah, that's a good score, but you've got one $500 credit card and you've only had it for a month. That doesn't tell a lender anything about your ability to manage your affairs. So lenders are usually looking for 2 active lines for 2 years and at least a $2,500 collective limit on those lines. So if you can maintain that and show them, over 2 years that you've managed your credit and you have enough credit, then that's classified as good credit. So there's more beyond the score. People get hung up on credit scores. I don't want you to pull my credit because you'll lower my score. Okay, we need to know what it is, because the score is just part of it. But the score can disqualify you, because lenders will have minimum cutoffs. They might say, 650 is our minimum cutoff. or 680 is their minimum credit cutoff. And guys, as mortgage brokers, we get frustrated. Well, 650 is your minimum credit score. That's 649. That's close. Well, okay, if we accept 649, we'll have to accept 648, 647, et cetera. So they're usually pretty hard and fast on what they want for minimum credit scores. But of course, alternative lenders, it might be a 580 score or a 550 score could be the minimum for an alternative lender. So private lenders, they don't care what your score is. You come to me for money. I don't care what your score is. I'm more concerned if have you paid your bills or not. So again, I'm looking at, do you have judgments against you? I couldn't care about your score. If you have a zero credit score, I couldn't care.
And is there equity in the deal in the case of private lenders? So when you start leaving the A space, shall we say, then is there equity in the deal?
Yeah, because as the client becomes weaker, then you're looking at, is there more protection for me when you default? So could I go 95% loan to value on a private deal? I could. I know if I have to power sale your property and hire a realtor to sell it for me, I'm probably 10% cost, so I'm already in the hole if you default. But if your income's good and your credit's good, then maybe there is some logic for me only having 5% equity. If you've got, marginal income, or you're self-employed and you're not reporting all of it, or you've got past credit history, I'm going to back off that loan to value because I always have to assume the worst. And the worst is you never make a payment to me. So based on my risk assessment, it's just I'm doing risk assessment. The more riskier you are, the more equity I'm going to want in the deal, just to protect myself.
So I never borrow money. So if I never borrow any money, wouldn't that mean I'd have a good credit score?
Yeah, you're screwed. You're like my dad. My dad, that was his philosophy. Yeah, pay cash for everything, never borrow any money. And if my dad had come to me and said, Bruce, I want you to get me a mortgage, I'll say, Dad, I can't get your mortgage. And he'd slap me and say, you're an idiot. I pay all my bills on time. What are you talking about? Well, it's a different world. You have to borrow money and pay it back. And that's how you establish your credit. So you have to prove to lenders, you can borrow money and pay it back. And that whether it's credit cards, car loans, lines of credit, really doesn't matter. But you've got to borrow money and prove that you can pay it back. And it's really as simple as that. That's all a credit card is. It's a short-term loan. I've had some clients say, credit card is my money. I've got a $20,000 limit. That's my money. That's your money. It's a loan. You've just taken a loan from your bank, a short-term loan, and you're supposed to pay it off every month. And if you can't pay it off every month, then you get charged interest. And that's how the banks make their money on credit cards, is hoping that you can't pay your money off. You can pay your credit card every month. It doesn't cost you anything to use it. It's great, but they're banking on the fact that you're going to live above your means and not be able to make that payment.
And then I know a topic that hasn't come up yet is net worth. So a client has the down payment, but they've got a whole bunch of loans outstanding, and the loans are greater than the money that they've got in the bank, and they've got a negative net worth. What is that going to do to your ability to buy a house?
Yes, well, that's going to impact it as well. Lenders are going to want to see positive net worth because, you can't be owe more than you're worth, and that's essentially if you borrowed money and you've got no assets against it, then again, why have you borrowed this money? So if you borrowed money and you've got an asset, like say you bought a vehicle, you've got a vehicle loan for $30,000, then we're going to show the value of your vehicle at $30,000. We hope your vehicle's worth at least as much as a loan. Often it isn't. The day you take it off the lot, it's probably worth less. But lenders want to feel confident that you have some positive net worth, that you're actually worth something. You've got some assets to your name. But if you're negative assets, if you just borrowed money and have nothing to show for it, then that's a red flag for lenders. Understandably, you're again living above your means. You've spent this money on who knows what, but you've got no asset to show for it.
Okay. Now, getting on to the property ladder, are there some programs that people can take advantage of? Like, can they use their RSPs? Is there a government program that helps you with down payment? What are the benefits to first-time home buyers?
Okay, well, there's several programs out there. You mentioned the RSP program. You can borrow $35,000 from your RSP and pay it back over time. And you can pull the money out without, paying taxes. So there'll be no tax withheld on that if it's for the purposes of buying a home. So a lot of people will use their RSP for that first-time home buyer program. And or if you haven't owned a home for 5 years, you're still eligible to use that program. The second thing you mentioned, yeah, the government of Canada came out with a program. I guess it was a year or so back, offering to have part ownership in your house, and they would give you so much down payment, but in exchange, they're taking an ownership position in your house. And the City of London has a similar program where, yeah, they will. There's programs out there for people. Now, I've looked at those extensively. I wouldn't advise them to anybody because the value of your home goes up to the point where, yeah, you're paying back a lot more than what you initially borrowed. So I wouldn't be using the government or the City of London for borrowing money, but it is an option for some people.
It is an option.
It is an
to get
option
on the property ladder
Yes.
if that is your aim. Yes, you do have to pay that back within 20 years.
I think it varies from city to city, program to program. But yeah, when I did the math on it, I said, yeah, this doesn't make a lot of sense for anybody. So we quickly sort of squashed. I don't even present that option to clients. I just don't think it's in their best interest.
Yeah.
I think for things like getting on the property ladder, you can be more creative. Like again, when I was 18, I bought my first house. I was a full-time university student. I couldn't get a mortgage. No bank was going to give me money. So I arranged what's called a vendor take-back financing. So the sellers of the home actually held the mortgage for me for a year. And then once I graduated and I had a full-time job, then I was able to go in and get financing from the bank and replace their financing. So getting a little more creative on how you get into that market. You should look at things like that. So vendor takebacks are possible. Rent to own scenarios are possible. We've done rent to owns where clients can't qualify for a mortgage for whatever reason. Credit's not high enough, income's not high enough, don't have a big enough down payment. Okay, but if you have something, then yeah, me as an investor, I might go buy the property for you. You will rent it from me until such time as you can get a mortgage. We will collect extra rent every month and put that towards your down payment to make sure once you are eligible that you do have enough down payment money, and then get them into the property ownership that way. But I guess I know there's one, I'm always bashing the coaches, the one coach saying, yeah, this is no money down into the real estate market, no money down. Well, it's not no money down. You don't own the property. You're just a renter until you can exercise the mortgage. Now you have the ownership. So saying I own a property when you're in a rental, no, you don't. You're a tenant. You're just in a program that's going to assist you in buying the property, but you don't actually own the property till you own the property, and then yeah, you've accumulated a down payment. So yeah, that's not no money down. It's whatever you've accumulated in terms of your down payment, and it's, yeah. So it's sort of again the slick marketing, and people think, oh, I can do that. I can do that. Well, it's not quite that easy.
Well, there's good rent-to-own deals and there's bad rent-to-own deals.
Yes.
Right. So in a good rent-to-own deal, the person that's selling you the property is going to kind of guide you to improve your credit.
Yes.
Is going to make sure that your money is going towards the down payment.
Yes.
And is going to help you to make sure that you qualify at the end.
Yes, exactly.
Right.
Yeah.
So I mean, there's good rent-to-own deals and bad rent-to-own deals. The bad ones, they're not going to guide you to improve your credit. They're not going to make sure that you can qualify. Matter of fact, they kind of hope that you can't.
Yes.
Right.
Yeah.
So.
Yeah, I have rent-own clients. I have rent-own property right now, and I've done rent-owns in the past. I sort of like the rent-owns, but yeah, I've got to make sure it's a win-win situation. So if they're rent-owning for 2 years, okay, what are we fixing? Okay, I got to fix my credit. Okay, you need to do A, B, C, and D to fix your credit. Or I don't have enough income. I've got a client. I want to buy a house. I'm living in England. I can't get qualification because it's foreign income. Okay, so yeah, so come back to Canada in a year and establish your income and then get your mortgage. So we'll figure out a solution for you. But yeah, I can look at a rent-to-own deal and say this is no good. Or even CMHC has rules for rent-to-own deals. They only want to lend off a rent-to-own if it meets the criteria of their rent-to-own requirements. So I look at it and say this won't pass the CMHC test for rent-to-own. So who gave you this document? Well, my coach gave it to me. Well, your coach is an idiot. So he's probably never done a rent-to-own deal. And if he has, again, he's not setting you up to succeed. He's,
Yeah.
I shouldn't pick on the coaches. You should slap me when I pick on the coaches.
Yeah, I just laugh at you. I like coaches. I've paid coaches myself to help us move forward.
Good.
But
it's good to have a good coach. So
it's good to have a good coach.
Yes.
So there you have it. There's options for people to get onto the property ladder, and the first one that you buy is the hardest,
It is, yeah.
right? And once you get moving and you get onto the property ladder, you start building equity, provided you've set up your financing properly,
Right. What?
that sort of stuff.
Well, that's the key, is knowing where you're at, have a good understanding of where you're at, and then, yeah, what options are available to you. So, yeah, I've got no income. Usually, if you've got 2 out of 3, we can find a way to make it work. It's when you come to us, I got no job, bad credit, no down payment. Okay, I don't think I can help you. If you have 2 of those 3 things working for you, then, yeah, we can maybe find a solution that works for you. Yeah, I've got no down payment. Okay, well, your credit and income are strong enough. You can borrow the down payment, so we'll help you get that. Or I've got a big down payment, but I've got no job. Okay, I don't care if you got a job. We'll do private financing, big down payment. I don't care. Yeah, 6 months we'll take you out once you're working and refinance. So yeah, don't be discouraged, but also, yeah, again, I go back to having your ducks lined up, understand your situation, and then, yeah, you know what you're dealing with. Or again, is it a vendor take back? Yeah, vendor take back. Why not?
Yeah.
As long as you can find a seller willing to do that.
And able, right? So sometimes when somebody's selling a property, they don't need the money and they
Yes.
want to help you.
Yeah, especially I find it older people. Yeah, they have to be mortgage free because they can't. They have to be able to discharge their mortgage. They can't hold a mortgage and have their bank at the same time. So they have to discharge if they have a mortgage. But if they're mortgage free, and yeah, and the return that you're giving them, let's say you're going to pay them 5%, and they're thinking, oh, geez, I was going to sell my house and I was going to put it in the bank and make 1% or 2%. 5% sounds pretty good. Yeah, it does. So it goes back to, again, the realtors too, understanding that that's an option for people and asking the question, would you consider rent own or consider a vendor take back? No one asks the question, then you never get an answer. So a lot of times it's talking to the seller and explaining the situation. And I know the realtor, when we bought that house at 18, she was furious when she found out I was a full-time student. I said, it's none of your concern. Don't worry about it. You did your job.
Yeah.
Don't worry about it. It'll come through. And of course, I was confident that I'd have a job and be working. And see, when you go to school for finance, you learn a few tricks early on. So, right?
Perfect.
Yeah.
So. All right. Well, thanks so much for talking with me today. And thanks for tuning in. You can find Bruce at cashmanagementgroup.com. You can find me at beckwoodfinancial.com. And hopefully you've taken away perhaps a few tips or tricks to get onto the property ladder. Thanks so much and have a great day.